the Fed's rate cut trap and Trump's job data purge. So the economy's on fire and the Fed standing there like, should we grab the hose or pour on some rate cuts? So let's unpack and dive in. Hi guys, thank you so much for joining the baseline, and thank you guys so much for joining me. So today, Trump, he's screaming, and he's screaming, who started the fire? But who does he end up firing? He fires the guy who actually counted the flames. So this September, the Fed is 94.9% likely to cut rates. And nobody's asking what that actually means for your rent, for your groceries, or your future. So let me ask you guys this. Do you think this rate cut is going to help, or are we walking straight into economic quicksand? So this story is massive, not just for investors, but for anybody who buys food or pays rent, right? Because this isn't just about interest rates. This is about political pressure, manipulated job data, and a Fed backed into a corner. So today we're unpacking how one jobs report triggered a near certain rate cut. Now, why Trump fired the head of the Bureau of Labor Statistics, and how Powell might be about to light inflation back on fire just to avoid another recession. These are some of the things we got to cover, right? So the numbers were fake, and then they became worse. So here's what's going on, guys. In May, they said we added 144,000 jobs. And then, oops, they revised it down to 19,000. Now in June, from 147,000, and they revised it down to 14,000. And July, well, expected 120,000, and we got 73,000. So it's like they were counting with broken fingers or something. And at this point, Trump didn't blame the economy. He blamed the guy with the calculator. Maybe rightfully so, maybe not. That's for you guys to decide, right? But he fired the BLS commissioner. He's gone, just like that. Now, did the markets freak out? Or are they anticipating this rate cuts coming? I'm not sure. But before the jobs report, there was a 41% chance of a September cut. Now, after, it's now 82%. Now, it's 94.9%. So Wall Street basically said, don't care about inflation, just cut anyway. But Powell's worried, and rightfully so, I think, right? Because he said if we cut too early, inflation might come roaring back. But if we wait too long, the labor market dies. So he's stuck between the fire and the frying pan, right? Inflation's still here. Tariffs are still coming. And with all that being said, the Fed's inflation target is still about 2%. But right now we're at 2.8% and kind of stuck. Now add the tariffs, which Powell admits might cause a one-time spike in prices. But I don't know, one time, like when your landlord says it's a temporary rate hike or rent hike. So is the Fed fracturing here? And this is the twist of the whole thing. The two Fed board members, Waller and Bowman, both Trump appointees, dissented last meeting. They wanted to cut rates early. Now, that hasn't happened in, 3 decades? And September isn't just about rates. It's when the Fed revises their entire forecast. So if they cut now, they're going to need to cut again, which means easier money, which sounds really good, especially right before the 2026 election ramps up. Now, here's the problem, right? The jobs market, it's weak, and inflation, it's sticky, tariffs, they're coming, and the Fed is fractured, and Trump's already reshaping the data narrative before the Fed even moves. So cut too soon, we risk stagflation. Cut too late, we risk a full-blown recession. And the only people guaranteed to win is Wall Street. Now, if you think this is bad, wait until you see how the Fed or the Fed's rate cuts could rig the entire 2026 election narrative. And that's what we're going to dive into the next round. So if you get a free moment, hit that subscribe button and the like button, because these guys, the game they're playing, you're the only one that's going to pay for it. You, I, all of us together, right? We're the ones that end up paying for it. Anyway, guys, thank you so much for watching The Baseline. I appreciate you. And we're going to catch you guys on the next round. All right. Cheers, everybody.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery. Given the unprecedented nature of the disruptions related to the pandemic and the reopening of the economy, we remain attentive to risks and will ensure that our policy is well positioned to address the full range of plausible economic outcomes. I will say more about our monetary policy decisions after reviewing recent economic developments. Economic activity expanded at a 6.5% pace in the first half of the year, reflecting progress on vaccinations, the reopening of the economy, and strong policy support. In the third quarter, real GDP growth slowed notably from this rapid pace. The summer's surge in COVID cases from the Delta variant has held back the recovery in the sectors most adversely affected by the pandemic, including travel and leisure. Activity has also been restrained by supply constraints and bottlenecks, notably in the motor vehicle industry. As a result, both household spending and business investment flattened out last quarter. Nonetheless, aggregate demand has been very strong this year, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. With COVID case counts receding further and progress on vaccinations, economic growth should pick up this quarter, resulting in strong growth for the year as a whole. Conditions in the labor market have continued to improve, and demand for workers remains very strong. As with overall economic activity, the pace of improvement slowed with the rise in COVID cases.